I'm Oliver Sloup with Blue Line Futures, coming to you from the Chicago Board of Trade with your first Tech Talk of 2021. It is Tuesday, January 5th. We've got a handful of markets here for you: corn, soybeans, live cattle, and lean hogs. We're going to kind of bundle the corn and the soybeans together and touch on a point that we've been talking about for the past several weeks in our daily grain express or daily grain commentary, as well as some of the previous Tech Talks that we've done, and that is finding technical support and resistance levels. And when we look for those levels, we look at the charts as a roadmap of previous interaction between buyers and sellers. And up here at 6-year highs, we don't have that to go off of. So we've referred to it as a fool's errand, finding technical resistance, especially in this market environment where you're starting to get these ranges expanding quite a bit. And that's probably going to lead and feed on itself to a little bit more volatility. When you get these ranges expanding quite a bit, you create an emotional trade, potentially some FOMO, or the fear of missing out, and people grasping at the market saying, I got to be in it, I can't miss the move. Well, we've had a tremendous move already, and unfortunately, if you're thinking that, you probably already missed it. And that's okay, because the market will be here tomorrow, it'll be here next year, it'll be here the year after that. So you don't want to be chasing markets. You want to resist the FOMO and resist that emotional trade, because those emotions create a little bit of irrational decision making. So where is the top in this? Well, like I just mentioned, it's really tough telling, but we are starting to see kind of the market bubble up, the volatility expanding, and that's, I think, indicative of a little bit of nervousness in the market from market participants. And if we do start seeing these taller candles in the top end of the ranges, you could start to see that lead to a little bit more long liquidation from the funds who have established a pretty large net long position. Now, I understand the fundamental backdrop is pretty stout for the soybean market. There's no denying that. I'm a little bit more concerned about the fundamental backdrop in the corn market. Now, soybeans continue higher. It's probably going to drag corn right along with it. But looking at where the funds stand with the corn, we posted this in our new Facebook group, Ag Chat Without the BS for Hedgers and Traders. Check that out if you haven't already. Taking a look at the fund position, this was posted by Karen Braun, one of our good friends over at Reuters. You can see that this is really against the trend for this time of year. And you can see that the funds, this black line here, are holding a very large net long position. And if one of those funds starts to exit, or two of those funds, or just people start to exit in general, you could start to see that feed on itself, and you could start to see those bullish headlines dissipate. We often say price precedes news. So there's a news story for every day that describes the market, but it's not necessarily correlated. It just happens to be so. So something to keep an eye on there. On the corn, we don't mind being short right here, but we want to defend those highs from the overnight trade on Sunday night, which comes in closer to $4.97, I believe $4.97 3/4 to $5. If the bears can't defend that, we'll rip our Band-Aid off and reassess things. If you're a producer, I think you want to start to be a little bit more active as well, and at least kind of consider putting a floor in the market. Again, I'm not calling for a top. I think this is just a tradable opportunity with limited risk. So that's what we're looking at there for corn. Soybeans, tread lightly, my friends. I'm going to pull up the intraday 1 minute and just kind of show you the volatility that we saw today. There's a bit of a flash crash here, and let's see if we can get this down here. Right about 110, 109. I don't know why it's being so funky like that. We saw this big drop. This is a 1 minute chart. So yeah, this was 109 to 110. We fell roughly to the lows close to 20 cents. That is some volatility, and we are expecting that to continue. Not necessarily moves like that, but just wide ranges, creating that emotional trade. So if you want to be in this market, be prepared to withstand those intraday moves. And if you're losing sleep at night, chances are you probably got too big of a position on, so you want to be able to maybe size a little bit more appropriately on that end. And that's another note: wider ranges, you want to adjust your position sizing accordingly. Now, moving over to the livestock side of things, we talked about potential inverse head and shoulders here in the February live cattle. We've been writing about being maybe a little bit more skeptical on February live cattle, but if I were to close my eyes and look at this chart without knowing what it was, I would say it's pretty friendly. we reversed all of yesterday's losses. We're still towards the upper end of the range. 116 to 116.50 is the top end of the range from the end of December, as well as going back to August, September, and October. If we get out above there, the market's could run, and we've got a gap to fill. It comes in a little bit closer towards that 120 handle. Now, one of the things we've been talking about in those morning reports is being skeptical February, but optimistic those deferred months. I think there's value longer term out towards April and June. Here's that April chart. If we get out above the top end of the range, I think there are clear skies ahead. Knock on wood, that's barring any major concerns in the outside market. I think we could make a run and a revisit back into the mid 120s. So that's what we're looking at for live cattle. Wrapping things up with the lean hog market. Lean hogs got out above the top end of this recent range. Tagged these highs here from October 16th to a T, 72 even, backed off. That was 4-star resistance for us, and now potentially moving the range a little bit higher. Previous resistance here now becomes support, what the bulls want to defend, which comes in close to 69. Break and close below there will neutralize the bullish developments that we've seen here recently, but we still are a little bit upbeat. If we get out above 72, I think this market has some more movement to the upside. Potentially make a run towards the mid to upper 70s. Again, you might want to look out to the deferred contracts. One of the things we've also been talking about is fund money. We've seen a lot of commodities rally substantially to new contract highs on the back of a weaker dollar. Grains, energies have performed pretty well. Precious metals have performed very well. Stock indices, Bitcoin, you name it. Basically, not all of them, but a lot of them have performed. The lagging commodity sectors has been the livestock market. So we wouldn't be surprised to see some sort of a catch-up trade there in the first quarter. So that's what we're looking at. That's what you should be looking at too. This has been Oliver Sloup with Blue Line Futures from the Chicago Board of Trade. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors. Thanks a lot.